Small Business Tuesday continues with Your Money, Your Call.
Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open right now on 1300 30 34 35, or if you prefer, you can always email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we're very lucky to have Richard Hemming from Under the Radar and also Carl Capolingua from Investor Systems. Oh, well, what a day and what a start to 2016. A lot of people out there will be asking themselves, is it going to get worse? And what do you do in situations like this? So let's go straight to our panel and ask them that exact question. Carl, I'll start off with you. Lots of market volatility. It's been horrible for a lot of the blue chips on the market, especially the banking space, but it's not an Australian-centric story. We're seeing it playing out globally. What are your thoughts around this?
Yeah, exactly. And look, I, as you know, tend to comment more from the technical perspective than the fundamental perspective. And there's a coordinated move down in global equities at the moment, and conversely, a coordinated move up in bonds and gold. And it's, you put all those things together historically, it hasn't been because good things are happening in the world economy. It's typically because there are things feared on the horizon potentially. Now, whether those things eventuate, and you can, we've got a list as long as my arm as to what could go wrong in terms of European bank failures, a potential credit crisis ensuing from that, the Chinese devaluation, emerging market crises with US dollar denominated debt, the Fed getting their business wrong. The list goes on and on and on. And I think the world's just pricing in some of these. It's not happening. It didn't just happen today, Julie. It's been happening since April last year. So people really shouldn't be surprised that this is happening. Anybody that could look at a chart would see that the trend's changed a long time ago. So.
So, Carl, generally with situations like this, the rule is, it's okay to sell as long as you sell early. But of course, a lot of the selling has already occurred. Yeah. The banks are down more than 30% from April. What do you do in situations like this? Yeah,
that's a really good question. So, I just talked about everything that's happened. It's not necessarily going to help you make a decision for what's going to happen. I think that's why people tune into shows like this. We started.
Okay, so now we have to come up with answers.
Well, we should.
We have 2 minutes.
We started at 6,000. We're currently at 48. My models suggest we've still got to get to somewhere around 46. Failing that, it could be as low as 43. Timing is everything, suggesting first half this year. So I don't think it's too late to get out even now. Having said that, the benefits of doing so are significantly less than acting upon, sell signals, which started occurring, as I said, April last year. With leaving it this late to do so, the risks that you make the wrong decision clearly are increased.
Okay,
well, that was a good hedge there.
I'm going to put you on the spot as well, Richard, because today we saw the market sold down extremely heavily. The ASX 20 was down a massive 3.3%. The small ords, though, did fare a little bit better, down by 2%. In this type of environment, are you looking for bargains or are you battening down the hatches?
Look, I think in this sort of market, this is what investors look for, really. Because volatility means there's opportunities. If everything was in a linear sort of straight line, there wouldn't be any way you could do any better than anyone else. So, like I've said to you in the past, dividends are important, but balance sheets are more important. And what's just as important as the balance sheets is the cash flow. So, with the reporting season coming up, it's important for all investors to notice not just the cash flow, not just the balance sheet, not just the debt and the cash, but also whether they can whether those cash reserves are going to get squashed. So I think now is a really good opportunity to buy stocks that can position your portfolio for the future, to use a often used cliche.
So looking for opportunities in this type of market, and I guess it depends on how long this market route lasts.
Well, look, I think the whole route is very concentrated, right? At the moment, you're seeing a lot of these financials hit, and the key to remember is don't fight the Fed. And ever since the Fed has gone onto its interest rate hike, ever since then, the markets have been selling off. And now you've got, I guess you've got Deutsche Bank having to change its de-gear its balance sheet from 50 times to say 20 times or something because of increased capital requirements. And like that is having a big effect on the financial system, and that effect is happening here with the increased capital requirements of the Australian banks. It's not quite as magnified. But I'm just saying, like, at the moment, there's a lot of debt overhanging the system, and there's a lot of change, at the big end of town in the financial system.
Okay, so lots of warning signs flashing in different asset classes, but I guess all this volatility also means there's opportunities out there. So we'll be talking about some of those opportunities in the type of market that we're in at the moment later on in the show. For the time being, though, we do have our first caller on the line, so let's go straight to Danny from Melbourne. Danny, welcome to the show. How can we help you out today?
Hi, Julia. Thanks. I've got an odd question. President Obama's $10 tax on the barrels of oil, do you think it would ease the volatility of the share market? But can I just lead you through my line of thinking? Like, you have the electric cars now, and they can do 500 kilometres before you have to recharge them. They take a couple of hours to recharge, where a normal car you can refuel in a couple of minutes. So 10, 15 years, they'll work out problems like that, and we're heading for clean energy. So I can see oil just going down and out like coal. And so then you look at the oil-producing nations like Saudi Arabia and Russia that depend on these sort of revenues, and they're not getting them at the moment. So they've got, money invested in share markets across the world, and so if they need money, they're pulling it out now, and you sort of see, I hear people saying there's no correlation between oil and equity, but then you look at the selling of the oil going down lower.
We're talking about the correlation between oil and equity markets that we have seen. But I guess just having a look at this question, and looking at the oil market in particular, there has been a lot of volatility in this space. And I guess the whole thinking behind this potential $10 tax on oil over in the US is all about clean transportation.
The $10 tax
and in this type of environment, I don't think
$10 tax is nothing. It's $1.5 trillion of junk bond holders that own whose bonds relate to the the fracking revolution in the US and the arm wrestle that's occurring between Saudi Arabia or the OPEC and the new kid on the block, the unconventional producers. I mean, that's the big story. And I mean, like, the thing with oil is, like, you can't store it in the same way that you can store iron ore. So you can't store it above the ground, really. So there's faster supply adjustments that can occur. So once the inventory dump that inevitably occurs onto the market happens, the market will be looking towards the next sort of step. So there is the potential for oil to jump back quite quickly, unlike, say, iron ore. So I guess, at the moment, you're going to see a lot of supply in North America contract as some of those companies go bankrupt. So in the next 6 months, I think is the key sort of, at the moment, we're in the key sort of period when those companies, because you think about it, all their balance sheets are based on $60 or $40 to $60 oil. Once that gets downgraded to $30 in oil, that's going to be like default city.
Okay, so if you are interested in oil, what's a small cap idea in this space?
Well, I don't know whether, I think in this sort of situation, the oil situation, you play stocks that have a good balance sheet and can survive.
Okay, so going towards the Woodside Petroleum.
Well, I think you've got to look at companies that can survive the storm, and you've got to, in this coming, you've got to look at their cash flow, as I said before, because that's the key.
Okay, so balance sheets are key in this type of environment. I mean, Carl, looking at oil, I'm sure there will be a lot of people interested in the technical view on oil. Usually when we do see, this mismatch between supply and demand. It takes a number of years to work its way through the system. And what's your view on oil? Are you interested in it? Are you staying away?
I look interested, but I still think it's got a long way to fall. So even at these levels, so interested would only be from the short side. The trend's just well established. It's had opportunities to bounce over the last few weeks, and each time it's been belted back down again quite decisively. Look, on the tax, which is what the question was about, I don't think many people who control a lot of money are really taking it all that seriously that it'll actually occur. If it were to occur, and I'll just take the cynic's view here, the biggest selling automobile in the US right now is the F-150 truck, and that's because petrol's cheap again. So wouldn't it be ironic if oil got a $10 tax now that Americans have gone out and bought their big trucks? You never know.
Okay, we do need to take a break, but we'll be back with more after this short break. If you'd like to speak with our expert panel, our number's 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35 and emails yourmoney@skynews.com.au. And we now have Mick on the line from Sydney. Mick, welcome to the program. How can we help you out today? Hi, Mick.
Hi. Good evening, panel. My question's about two stocks. The first one's VXR, Venturex, and the second one is Triton Resources, TON. Just want to know what the panel thinks of them.
Sure. So having a look at the smaller end of the resource space, Venturex, VXR is the stock code there. Very small market cap of just $9 million. And Triton, TON, which has a market cap of about $34 million. And I guess we'll just expand it out to talk about the small cap resource space at the moment. If you're not in production, even if it is in an area like gold, which is rallying, is it still going to do well on the back of those higher gold prices?
A while ago, I just sort of made the decision to look at only sort of diversified resource plays. And when I say diversified, I mean like multi-mine.
Why is that?
Well, I just think one mine operations are too vulnerable to mining risk, and there's enough risk out there in the commodity price. And I think we've seen, I saw you shouting for the heavens before about Northern Star, and I think we've all seen big performance of the really good recent performance of some of these diversified gold companies, like Northern Star, Evolution Mining. Ramelius, but I tend to think that the speculative side, you're not getting rewarded for how much risk capital you're putting in. So I think that that's a very hard sector to play. I mean, some companies, they come up with a discovery, and there's a bit of a spike, but then very quickly the stock price comes back. I think it's a very difficult sector to play.
Okay. I mean, Triton's also involved in graphite, which is still an emerging story, but of course, share price hasn't been doing so well. So
graphite's like, I guess, kind of at the hard edge of the speculative spectrum, because you've got that's a good sort of alliteration there. But I think like even Zero Resources, they were kind of had first mover advantage, but everyone else is sort of struggling because I guess how much graphite does the world need? And then they've got the the graphene sort of component to things. So it's supposed to be like a miracle product, but there should be some skepticism as to whether the industry's claims can be matched.
Okay. I mean, I guess the problem, Carl, with these early stage projects is, of course, you not only want to get the resources out of the ground, but you need to build the infrastructure, especially when you're looking at places like Mozambique. When you're looking at the material space, what type of metals or commodities are looking the most attractive when you're looking at, gold or base metals, copper? If you're looking at
that's a
lithium,
loaded
graphite,
question.
what do you think?
Julie, it's a loaded question because I know that you're long gold at the moment.
And I'm long graphite.
So you want me to talk about it? No, look, absolute standout at the moment in that space is definitely gold. But it's you look at what's running the most, and it's mainly the producers have stacked on the most. And I know we all love to buy that magic stock at 0.5% and see it go to $500 million.
Well, there hasn't been a Serious Resources, since Serious Resources, and that was like a number of years ago now.
Oh, that's a very good pun.
And nickel prices haven't been doing so well. But I mean, looking at commodities, what do you think, Carl? Are you buying anything?
You mentioned lithium. Look, the question was about VRX. So I do want to give a comment on that one. And just this concept of getting that key mining stock that you're after. I really don't think this one is it. The market is telling you that there are very few eyes on this stock, doing the research on this stock, investigating the story, understanding the story, getting excited about the story. The stock is in a significant downtrend. It's been that way for well over a year. There's very little volume on the stock. That's also another example. There are very few people with money looking to invest in this stock. So if the big money is ignoring it, you have to ask the question why you would put your hard-earned cash into it. I think you're much better off looking for a stock that is in an uptrend at the very least, or if it has had a big downtrend, at least it's got a good sideways basing pattern where you've got rid of that supply overhang. It's being equated with a little bit of demand, but the key to everything is volume. The key to picking these little specky mining stocks is that there is interest. Interest is volume. It's like the knob on your stereo. You turn, that's what volume is. You turn the knob on your stereo down, the volume down, and nobody can hear it. Turn the volume up on a stock, it's like turning the volume up on your stereo, and that's the one you want to go for. In that regard, I would avoid TON as well. And the one that I'm really interested in at the moment is AJM, which is Altura Mining. It's just starting to come up on my scans the last few days, so it's a fairly new one for me to be investigating, but it does have all those characteristics that you do want to see on these small mining stocks.
I've watched that for a long time, Altura.
Yeah, and that's it. You can watch these stocks for years and years and years, and they do nothing.
Well, they kind of had they were kind of in coal mining.
And they
had a stake in Mount Webber, and so everything they touched.
You mentioned before multi-commodity plays.
Diverse,
these guys.
Not multi-commodity, more like because I was
multi-mine, right?
Yes.
Well,
sorry?
they're producing.
Altura is lithium.
But they've reinvented themselves again. I was just saying, when I looked at them, they were coal and they were producing coal.
They are producing
from
coal,
Indonesia.
but they're getting really close actually to getting some lithium out of the Pilbara.
These guys are going to find something.
No, they've found it, and that's the key. So you can find these ones that are kicking over rocks in the desert that have
but it's
nothing.
Funny. How did you know? How did it come up on your radar?
How did it come up?
Okay, so the way I operate is you go under the radar.
You're in there.
I'm on top of the radar.
What were you looking for?
Okay, so I'm looking for all the things I just talked about. I'm looking for price appreciation. I'm looking for volume interest to tell me that people are interested in it. And I've got an algorithm. It's not one of those high frequency trading type algorithms. It's just looking for simple supply demand clues that are telling me people are moving into this stock. And this thing has got all of that written all over it. It is a lithium play. They're not that far away. Next 12 to 18 months of actually shipping some lithium. They're producing coal at the moment, so there's a little bit of cash flow. They're not cash flow positive, having said that, but all of that are fundamentals, and I don't care about those. The chart's starting to look really good. I'd certainly be buying it around the current levels and through that sort of 7.5. I think you've got a really low risk play here, stop around sort of 4, and I can see this getting to 20 cents in the medium term.
Okay, so that was some of the
smaller
end of the market there. Let's go to our next caller. We have Max from Perth on the line. Max, welcome to the show. How can we help you?
Hi, Julian, guys. Thanks for taking my call. CSL, I heard one of the gentlemen earlier in the week on the morning saying they may split the shares. They did apparently years ago 50-50. This time they were talking about doing it 3 ways. And your thoughts on a buy at this price for CSL and also Cochlear.
Sure,
I'll listen. Thank you very much.
Sure. So looking at that healthcare space, and healthcare usually does tend to outperform in times of volatility. CSL, it's been one of the darlings of the market. So let's start by talking about CSL. I might go to Carl first to talk about the psychology behind something like a share split, whether that would make a difference to his outlook in terms of CSL's share price, and indeed what he thinks of CSL at the moment.
Yeah, I mean, if you look at the research on, and this is all done based upon US stocks, splits tend to be quite positive for the company over the next sort of 6 to 12 months. there's just not enough data for Australian stocks to draw any strong conclusions for that. It just happens so rarely over here. For me, it's a little bit of a moot point whether they do or they don't. I'm more interested in, I guess, the underlying trend of the stock, which represents the underlying fundamentals. And the trend, without a doubt, is spectacular. It's one of the stalwarts of the market. It's definitely in an overall bull phase. Having said that, I'd be starting to get a little bit cautious on these healthcare stocks at the moment. You tend to find when markets start to get really nasties, I think they're probably going to get in the very, very short term. Some of these stocks that have done really well for the fund managers tend to be sold off only to pay for some of those losses and just bring things back into balance. And I'm seeing some of the signs of that coming in terms of the price action and the volume at the moment. So I'd be a little bit cautious on CSL. Cochlear is a very similar chart from a technical perspective. I'd also be a little bit cautious on that. I think if you're booking some really great profits on them, it's not a terrible time to be locking some of those in at the moment. And by the same token, I'm not really going to be a buyer of either of those at this level.
Okay, so locking in some of the profits there from Carl, from more of a fundamental point of view, do you like CSL or do you like Cochlear? What do you think?
Well, I think locking in profits is probably a good thing to do at this sort of time in the market. So I'd encourage anyone to think about locking in profits. But I'd say with the health sector, it certainly had such a good run that they're starting to look, to me, across the board, quite expensive. I mean, even the sort of smaller stocks that we cover, we've got holds to take profits on them. So I think, with health companies, sure, they're going to be, a lot of these big ones as well are going to be benefiting from a weaker Australian dollar. But I guess in terms of justifying 30 plus PE multiples, some of them have very good models. Like business models, so they can sort of generate the kind of consistent profit growth that is required to justify that. But like how successfully they can do that forever is the question.
Okay, so we were looking at the healthcare space. This space does tend to outperform during market volatility and times like this. In fact, if you're looking at some of the defensive areas, there are areas like healthcare, utilities, telecom and consumer staples, which do tend to outperform the rest of the market when we do see the market turning down. That's because a lot of fund managers do need to keep a minimum weight in equities, so they do tend to move towards the defensive stocks. That's not to say that we don't see falls in these areas. It's just to say that they tend to fall less than the rest of the market. We will be back with more after this short break. If you'd like to speak with that expert panel, our phone lines are open on 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to the program. Joining me on the panel tonight is Richard Hemming from Under the Radar and Capolingua from Investor Systems. And I'm Julia Lee from Venturex. If you have a question you'd like answered, our phone lines are open on 1300 30 34 35, or you can email yourmoney@skynews.com.au. And we now have Kerry on the line from the Gold Coast. Kerry, welcome to the show. How can we help you out?
Hello, panel.
Hi.
Good to see you back, Carl.
G'day, Kerry.
For one of the better ones, mate. Just on general comment about the market, just chart the banks, and it's clearly obvious they are going down. They've broken down from massive head and shoulder top patterns. NAB, ANZ are broken. Look at them. Westpac's about to break. Just a little roughies come up in my scans, mate. LTX, what you said before, the volume today got me, the scan come through the volume today, and they got money, tight structure, but on my radar today, just come up there on the scan, but it seems to be going to make a move. Presently in the lithium and graphite, what they're going to do, I don't know.
Okay, so this is, a good question, because it's a $5 million market cap. So what happens when you become interested in volume in a $5 million market cap, where, yes, volume spiked, but it's still a $5 million market cap company, and, it's still relatively trading light type of volumes. What do you think, Carl?
Yeah, look, it's very small, very, very small. It definitely flies under my radar. The last stock I talked about is more like a 60 million cap, and that's very much at the bottom end. So I normally wouldn't be looking at something like this. But the question's been asked, what do I think about the volume and the price action? And it actually looks quite interesting here. It's not one that I would go out and take a second mortgage on the house. I think this is all risk money. The stock's trading at 3.7 cents. So if you put a few $1,000 on it. Not that I'm giving you any advice whatsoever, and expect to lose it. Having said that, I think it's definitely prospective. Kerry's picked up on all the things that I like to look at, as he tends to do.
But it didn't trade for almost a whole year.
If you look at
it went into voluntary suspension, and then it went and extended that suspension. It's just looked at a capital raising, I think, for $800,000.
This is definitely not the best stock out there. It's not one I would recommend to my best or my worst clients. As I said, Julie, it's just a punt, and we've got to respect the fact that there are people out there that, as much as we think they should be investing in quality blue chip stocks with dividends and cash flows, all they want to do with their money is punt, and that's fine as well.
I mean, I'd be totally in favour if you knew the company inside out, but trading a stock that's $5 million market cap that didn't trade for a whole year and that has suddenly seen volume spike.
You know what? I actually think the less you know about these little ones, the better. Because in my experience, hold that thought. In my experience, it tends to be, and I'm sure the viewers can relate to this, the more you know about these little specky stocks, the more money you tend to lose on them. Okay, because you know the story, you get tied in with it, and it's really hard to let them go. My philosophy is don't know anything about them at all. If the chart's going up, buy them, and vice versa. There's something going on here. I'm not saying it's the best one out there. I'm answering Kerry's question. It has had that big base pattern. That's really important. Volume started to come in July last year. That's important. It's had a quiet period. It's doing all the things I look at. That's all I can say.
Let's move on, because at the end of the day, it is still an extremely tiny company.
It is tiny.
Let's go to Tony from Sydney. Tony, welcome to the show. How can we help you out today?
Hi, Julia. How are you?
Good.
That's good. I've got a question about the healthcare sector again. So my question is a little bit more general. The free trade agreement with China and the middle class of China sort of burgeoning, and where potentially we could sort of profit or see some sort of growth.
Just in relation to the healthcare space?
Yes, that's right.
Okay. So questions regarding healthcare space and the FTA, the free trade agreement with China. I mean, a lot of people focus in on things like cattle and dairy, but what about healthcare? Do you see any benefits here, Richard?
Well, I think there could be benefits for some of the hospital providers like Ramsay's, but I think. So I think there could be, but I think there's so much sort of secrecy surrounding this deal that I don't think anyone in their right mind would make an investment decision based on the free trade agreement that we've got with China, because it's going to benefit some people at the big end of town, but we're never actually going to know how much it's going to benefit them, and I think, as much as the government's trying to make, sort of glorified as this economic sort of saviour for our economy, I really don't think it is. And I think that it's not going to be the be all. Like, I mean, just in another sector like Freedom Foods, they did some deal based on the free trade agreement, and I think that the actual deal isn't going to make them any money in the foreseeable future. And that, in equity markets, you really want to see some tangible benefits sooner rather than later, because it's just pie in the sky stuff. So unfortunately, I'm just very sceptical, I think, Carl and Julia.
Yeah, I mean,
I'm just very sceptical.
I mean, it will open up.
If it's so great, why can't they tell us any details? I mean, it's just ridiculous.
I mean, it will open up opportunities for the healthcare space, but you're absolutely right that it's very difficult to see
like Bellamy's, right? Bellamy's is a kind of arguably in the kind of space that we're talking about here, also the food and Blackmores, and they're still in a situation where there's people are buying cans of formula from the supermarkets and then selling them online to the Chinese equivalent of eBay, the auction site. So that's where a lot of their export revenues are coming from. So I'm pretty skeptical of that. So maybe those lines could be improved in terms of like the export market for, say, a Bellamy's. And in that case, I would think, like there's clearly a big demand in China for that product, but the what the company's coming out with is very opaque in terms of what their actual exports are, because of people rushing around supermarkets trying to buy it and then auction it off.
So, Tony, it looks like there will be a positive impact for the healthcare space, but at this point in time, it's difficult to see exactly how that's going to materialise or which particular companies that's going to benefit. It could be the aged care space, it could be medical devices. We just don't know at this stage, but certainly the opportunity there is to expand. And as Richard mentioned, Ramsay Healthcare is looking at hospitals in China, so that will be an interesting one to be tracking. Let's go to our next caller. We've got Ben on the line from Brisbane. Ben, welcome to the show. How can we help you?
Thanks, Julia. Just a technical off Carl, please, on TSN. Looks like it's in blue sky. I was asking for a price target. Thanks.
Sure. So price target for Transaction Solutions. I think this one's ATMs over in India. What do you think, Carl?
It's had a big spike recently. It's not one that I've been looking at, so the opinion I give you is simply based upon the analysis I can do right now. But yeah, look, it's exactly one of those ones, Julia, that you wouldn't have bought in October. That big base pattern, volume came in, and then up she goes. And again, if you're going to play this spec game, that's what you need to look at. That's history. Where does it go from here? There's nothing really sinister in the charts to suggest that it can't keep going. It's all of 2.5 cents. It's not blue sky though, because it does have a history behind it where it's been up into sort of the high 4s. There's nothing here to suggest that medium term, short to medium term, it can't get back towards those levels. Again, it's really one for the specky bucket. But it looks good at this stage.
Okay, so I mean, this one's interesting. It installs, manages ATMs on behalf of a number of banks over in India. I think it's got probably about 1,500 ATMs in India. What's your view on this one, Richard?
Well, I think a number of companies that I've come across, I can't remember their names for the life of me, but have come up with this. We're going to tap into the burgeoning or nascent financial services ATM sector in India. I think the complications in that market are such that that I've never seen any of them gain any real lift-off. And I think the fact that this company's been around for a fair while but still hasn't produced any revenues of note sort of sums it up. The fact that this thing's still ticking over is a credit to the insurance.
The marketers within the company.
The insurance of the capital raising.
That's right.
Activities of the managing director or the board. But would you put your hard-earned money in something so speculative? I know that the gold price has spiked and people are suddenly getting quite excited. Well, I think that's probably an understatement from what we've heard tonight. But but I think that everyone's got to remember the leverage that's already there in the market, right? That's already there. Look at the financial services sector. I know. We've heard the banks are going down from a caller before, but that doesn't mean that all financial sectors are ruined. I mean, we've seen a 6% fall in the markets recently, and that's led to like 15, 20, 25% fall of some financial services stocks, like some of these wealth managers. So, some fund managers, not me, but some fund managers that I've been speaking to are certainly, buying up at this point on that fall. So, I think there's so much leverage out there in the real market with companies with real earnings that I don't necessarily think you have to bother about these sort of companies where really you just I think you Carl said you can throw $2,000 at them and not expect to get it back.
Not my bread and butter at all.
Well, I'm not saying. I'm just saying
people want to know about them. At the end of the day,
I think it's going to be very difficult to know about a company where the level of disclosure in India is very low. There's a reason a company is listed here where its operations are in India, because you can't see them, so they can get away with stuff. Okay. Look, I hate to say it, but that's just how it is.
Well, it's hard to give a fundamental view because you can't know every stock.
Well,
I guess that's where
it's hard
charting
to get anything.
There's an advantage in being able to do the charting, because you don't have to know the story.
Okay, so that was TSN. If you are interested in this company, I guess you can also contact Redleaf, which recently did the capital raising for $500,000, and we've had some of the Redleaf staff on here as well on Your Money, Your Call. Let's go to Tim from Ballarat. Tim, welcome to the show. How can we help you?
Yeah, thanks for taking the call. I just wanted to get the panel's view on Yowie, YOW, and Catapult, CAT.
Sure.
Yeah, with Catapult, I've owned both of these stocks. Catapult's doing quite well. Yowie's pulled back a bit. So just your opinion, please.
Sure. I mean, both of these companies are the type of things that I look for, and that is increasing momentum, in terms of the earnings and the revenue picture. In terms of Catapult, it's been doing extremely well. We've seen unit sales in the second quarter reaching a record of 2,000. I think that was up about 60% or 66% or something phenomenal like that. Yowie, we know, is expanding throughout the US, but the stock price isn't doing so well. It probably will need a capital raising at some point. And not only that, we've just recently heard that there's, I think, about 329 Walmart stores that will be closing throughout the US. So I guess it's US expansion.
That's among thousands of stores.
I mean, stores.
Yeah, okay. But I think the point is, when you're looking at these big figures, like I've started a business myself, if you're not seeing those hundreds of % increase in your sales or your earnings, you're not going to survive, because they're starting off a very low basis. So I think we have to remember that. I think both of them have some great IP, and that's like I've said this before in this show, that's at the core of what you really want. Because what you're buying is that IP, and then how much you pay for it's the question. And people are just very skeptical, I guess, of the Yowie thing, because like it's got a good story, but if it doesn't have, it doesn't achieve its targets in this window when it has patent protection, like, because they do these encapsulated chocolates that are meant to be like hobbits or something that roam around. I don't know.
They're
so they've got some environmental,
Australian
Australian hobbits, Australian endangered hobbits or some stuff. I mean, there's a lot of technical, obviously, juries across it. But I think you have to be a bit skeptical. Oh.
Let's bring it back to Catapult. I've just started going to the gym this year, and when I go to these classes, they have this thing that measures your heartbeat and monitors, and it's sort of going from
it's got resonance.
Athletes
to that's our lovely host.
Mainstream. But the Catapult business model, it's high margin, it's recurring revenue.
These things look so good on spreadsheets when you put in the numbers. You just get big. Well, I mean, but they have to they're not cash flow positive, but there's still an unproven business model. Like they're a nascent growing thing, and people are just trying, in this early phase, they cannot afford to disappoint. Like, the thing that keeps Bellamy's going is that, the story's still evolving, and people are still saying, oh no, the demand equation's still there. If they meet all the hurdles, people put little hurdles in front of them. If they achieve those hurdles, then people more and more start to fill in that missing picture, which is earnings.
Do you like Catapult or Yowie?
I like Yowie because I think they've got agreements with I think Walmart and the other big Safeway, I think. So they do have a window. It's a good story, but this is what we're talking about before. These are the types of stocks that if I was punting, or if I had $1,000 or $2,000 that I didn't want to take to the track and I just wanted to go on the ASX, this is the type of stock that I would be investing in.
They are small cap companies. What do you think, Carl?
Catapult's definitely the better of the two from a technical perspective.
Technical.
It looks fantastic. It hasn't been around very long, so it's literally only just started to come up on my model, or my model has just got enough data to be able to form an opinion of it, and it's very positive. Relative strength, amazing. So if you looked at this stock, you'd have no idea that there's a global financial crisis 2 just around the corner. I say that tongue-in-cheek, of course. Please don't sell your portfolios tomorrow. My point is, when the market gets belted, this thing goes up, and that is a very strong sign. So it's a stock I'd be happy to own. I'd be happy to recommend to my clients, even at the current levels. There's nothing sinister in the volume or the price action that would suggest that the current run is coming to an end. It's a complete stark contrast to Yowie, which the technicals look quite awful on. If I had Yowie, I don't think it's too late at all to sell it. Maybe there's a capital raising around the corner, and that's the reason for the current falls and impending fall, I believe. So yes on Catapult, and I would be out of Yowie.
Okay, we're going to take a short break, but we'll be back to answer more of your questions in just a moment. If you'd like to speak with that expert panel, call us on 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to the show. If you have a question you'd like answered, please pick up the phone and give us a call on 1300 30 34 35, or if you prefer, you can email us on yourmoney@skynews.com.au. And we now have Shane on the line from Sydney. Shane, welcome to the show. How can we help you?
Julia, I had two questions about two stocks, basically. The first one is directed at Richard. My question is, where is Osprey, OSP, ASX code, where is Osprey heading? Back to 85 cents from 30 cents? And the second question is for you, Julia, regarding A2 milk. Is A2 milk heading over $2 soon?
Sure. So let's start off by having a look at Osprey Medical. OSP is the stock code there. Interesting company. It looks at reducing the dyes when you go into certain heart surgeries or when you go into surgery. And you know, I never knew that having too much dye in your system, like colour dye,
basically
could be
poison.
bad.
Radioactive.
It poisons your kidneys.
It poisons your liver, and so in hospitals they can't get reimbursed for hospital-acquired conditions, so kind of means that they reduce the potential for, I guess, incidents after people do exploratory heart operations, or because they need to use this dye to see what they're doing. And I guess last year in October they came out with this big 578 patient study that showed that it wasn't. It wasn't effective, or that it didn't produce an effective enough outcome. So in terms of reducing, because they want to get the label to actually say, okay, it does reduce SIN or something, or clinic, which is like contrast-induced nephroscopy or something. So basically, that seems to have been overturned in this week's announcement, but the stock price hasn't reacted much. So it went from, like what the gentleman was saying, from 85 cents to 20 cents or 25 cents, and now it's sort of trading at 30 cents. So there is life in the old stock, and I think that. We're looking at it at the moment to see, to look through and see what's changed with the FDA's decision. Why when it did this extensive clinical trial and it didn't show any real benefit, why suddenly, the change of mind. But I think it's a bit disturbing that the market hasn't sort of re-rated the stock on the basis of this news. So I think that.
Would you be buying at these levels?
No, I think I was pretty disappointed after the last one. After they did the big patient study and it didn't show efficacy. So we would need to do a bit more research to find out whether they changed the parameters of the trial, or they change how it's managed to sort of come back from the dead.
Sure. And Carl, OSP or A2 milk?
Look, I wouldn't be in either of them at the moment. OSP, I think, will just have a massive supply overhang from all the people that believe the story before the announcement that are really just waiting to get out. So it's got a big gap to fill, and all the way through that, there'll be people looking to exit the trade at a loss. From a technical perspective, no, I certainly can't recommend that one. The other one was A2M. I think just in general, this story, I think, has run its course in the market. At least for the medium term. I mean, 3 to 6 months, probably base patterns around these levels before I think they've got any real chance of challenging those recent highs. I was on the last time on this show in November. I talked about A2, I talked about Bellamy's, I talked about Bega's. They've all since then gone up 30, sometimes 100%. They've all hit targets. Massive exhaustion moves, massive spikes in volume on those moves. A major supply overhang now from people who didn't get out, who are really going to be using any rally now as an opportunity to take their profits. So no, I'd be out of the milk, infant milk story as well.
Sure. So, Shane, I'm still in A2 Milk. I bought in at 49 cents. I've been doing quite well on the stock and still happy holding at these levels. The price action in terms of Bellamy's is a little bit concerning. And also, if you have a look at how small caps are performing in the US, I think that's a warning sign, because a lot of these companies that are trading at high PE ratios, the market is re-rating them at the moment and is nervous about these high valuations. It is, though, earnings season, and Bellamy's, I guess, is a good demonstration of what can happen when profit is increasing. You know, on Friday, stock was down 10%, and then it came up with an update, and the stock went from being down 10% to up 10%.
All
so
they
things
did was
are
reiterate their guidance.
Reiterating guidance. So it is a very nervous market. I am in A2 Milk, but I'd be putting stop losses in there. And I guess if it triggered that 155 mark, I'd be out of the stock and looking for a lower entry point, because I really do like the story. Having said that, though, you know, infant formula, there are more products coming to the market, and this is usually a warning sign. But still in A2 Milk at this stage, but warning signals, I think, in some of these milk formula stocks. Happy to hold it long term, but probably looking at picking up some more at a cheaper price. Let's go to our next caller. We've got Philip on the line from Victoria. Philip, welcome. How can we help you?
Thanks, Julia. Thanks for taking my call. You sort of answered my question anyway, but I'll ask it about Bellamy's. They had an update on Friday, as you know, and I'm just wondering what the long-term... I'm happy to hold them for the long term. Is there a long-term prospect for them?
Sure. And I've been in and out of Bellamy's as well, so picking them up at $2.20, but I'm out of Bellamy's at the moment. And I guess my concern around Bellamy's is there was a long time where you couldn't find their product at all on the market, and the same was the case with A2 Milk as well. And unfortunately, baby formula, because I have a young infant, once you switch baby formulas, you usually don't switch back, because you keep to the same one. It's not recommended that you switch formulas because it upsets their tummies, and there's a period of adjustment. So I think locally, in my mind, Bellamy's probably has lost a lot of its local following, and A2 Milk managed to get production on board a little bit earlier. I want to give a chance to our panelists to talk about Bellamy, but we do need to go to a short break, so we'll be back talking about Bellamy's after this break. Stay with us. Welcome back to the program. We're still here answering your questions on shares, so please give us a call on 1300 30 34 35, or you can send an email to yourmoney@skynews.com.au. I'm Julia Lee from Bell Direct, and joining me on tonight's panel we have Richard Hemming from Under the Radar and also Capolingua from Investor Systems. And before the break, we were talking Bellamy's, so let's give both of our panellists a chance to give their views on Bellamy's. Carl, we might go to you for a technical first. What do you think? I mean, the stock was up 700% last year, but it seems to be rolling into a downtrend. Is it going to continue? Yeah, look, I think it's more likely to either go sideways or down than it is to regain those highs anytime soon. Look, much the same as what I said before the break when answering the question about A2 Milk, which I do think looks superior to this one. And I think you've got a more logical stop point, as you suggested, on that. I think there's too much supply overhang from this around 15 key level. Massive spike, massive volume. I think the smart money will, if they're not already have got a couple of legs out of the bathtub, I think they'll be looking to get the other couple of legs out over the next few months. I mean, the other thing, Carl, is we're in the middle of earnings season. Does that affect the technicals at all? I mean, it usually can be, you know, a continuation of the trend or the start of a new trend. Yeah, look, absolutely. I mean, it's all about surprise, isn't it? So if you've got the market doesn't often get surprised as much as people think that the market does get surprised. I mean, these things are factored in. I mean, you've got analysts that pore over the fundamentals 24/7 in real time, analysing all of these external factors to come up with a valuation. So things are priced in real time. They're constantly priced. And when that result hits, it's literally just the bit that wasn't priced in that the market reacts to. So I'm of the camp that earnings is not a major deal breaker in trading. Because they should already be priced in. So you don't do anything differently during earnings season? No, I don't do anything differently. No, I tend to find that stocks that are in positive trends tend to deliver,
strong earnings results, and stocks in horrible trends tend to deliver poor earnings results, and that's borne out in lots of research as well, that stocks that start to upgrade tend to continue to upgrade, and stocks that start to downgrade tend to continue to downgrade as well. So
okay, and I'd be interested to get your views on Bellamy's, Richard, and I guess I'm a little bit biased. I'm still a bit upset that I couldn't find the baby formula, and I switched to A2 milk, and at least I could find A2 milk. Not only that, my local IGA charged me $37 for a tin of Bellamy's. You can get it on the website for $28. Anyway,
I think, I think what Carl's talking about is momentum, and we got into Bellamy's at like $1.80 or something like that, and I think when in markets, right, momentum is a reliable kind of indicator of. That's the most reliable, I guess, indicator of where things are going, but it can turn quickly, and then it can go the other way before you know it. And I guess momentum, momentum's working while it works, and then when it doesn't, you lose all your money. I mean, out of the financial crisis, we saw lots of quant funds go bust because of that principle. So I think you're only, in our philosophy, the only sort of defence you have against the volatility that we're seeing is buying early. And I think with this sort of stock, Bellamy's, we bought early and we've just been happy holders ever since. So all this sort of fluctuation at the top, we're not that worried about. And I think when it compared to A2, I prefer Bellamy's because I actually understand the Bellamy's story better than I understand the A2 story. Whereas you might say, oh, this chart makes more sense, the A2 chart or whatever. I mean, the A2, I cannot see the scientific backing for the product. The whole idea behind the product to me seems not trustworthy.
But it's a baby formula that's been powering.
Well, I understand that, but what's underlying that is this whole concept of A2 milk coming from specific cows or something, which has never actually been tested.
The New Zealand government is doing a study, I think, at the moment.
Oh, right. Well, they've taken their time, and the stock price is probably more than quintupled. Well, in the absence of any studies, so hype drives a lot of people's expectations, and I think obviously the A2 has a lot of power at the pump in the supermarket, not the petrol station. But I think with the Bellamy scenario, you can see that it has more of a fixation upon the Chinese, the Asian consumer, and that's why I said, when we first started covering it, this could be $1 billion stock purely because it's got that Asian factor. And I just don't know about that. I agree with you on a lot
of things. But look at Blackmores. Vitamins are shown, not to prolong your life, and yet, Asians are going crazy for them.
Well, I mean, I don't know the Blackmores story as well either, because I didn't really believe in the vitamins story, so I missed that one. But as I'm saying, I actually understood the Bellamy story better than, and we did miss Blackmores. But of Blackmores versus A2, Julia, I would actually understand the Blackmores story a lot easier than I understand the A2 story. But I mean, you're always going to miss wagons at times, and my point is, okay, if you miss it, don't go chasing it. That's the point that I'm making.
Okay, so that was Bellamy's. We were talking a lot about the baby infant formula stocks that had been doing so well in 2015, but are starting to look a little bit more shaky coming into some of these earnings reports. Let's go to our next caller. We've got David from the Southern Highlands. David, welcome to the show. How can we help you?
Hi. I'm a trend trader like Carl, and I've had Ramelius from about 18 or 19 cents.
Oh, beautiful.
And it just keeps going up, and I'm not going to sell it while it's going up, but I just wondered, with this current volatility and what it's doing, where would Carl say he stop, a trailing stop?
Okay, so looking at a trailing stop loss for Ramelius, so currently where would you be setting Ramelius's stop loss?
Yeah, look, a stock that's got great momentum. Obviously, Richard mentioned momentum. I think it'd be a shame if you'd never bought a stock that had great momentum. Because
we bought Bellamy.
I'll just finish this one, Richard. It's a shame if you never bought a stock that had great momentum because you're worried about the momentum ending. Now, make no mistake, all good things have to come to an end eventually, and that's why, much like this caller has discussed, you would have something like a trailing stop to protect you if the momentum changed, and it allows you to lock in a large proportion of your profits without having all the downside of holding all the way down. Certainly, I don't advocate holding a stock forever all the way down. We always use risk management procedures. So I think momentum's a good thing. It's how you make money in the markets. And more importantly is how you get out of the stocks, though, and protect those profits. On this point, it's tough to set a stop loss on here because it's had such a great run, 25 through to 36 in just a few days. So the most logical place to set a stop is just under that 25 level, which means you're giving up probably half of your profits. Having said that, I still think it's a sensible thing to do to have a stop around that level. Target something on this one, I think it could see 50. I think there's a 5 handle there, into 55, probably into the max. In terms of gold stocks, I also like St Barbara. I think that's still very prospective in Saracen. So SBM and SAR. I covered Northern Star and Evolution in October when I was here and said they were great buys. I'd probably be looking to lock in profits on those and rotate into a couple of those other ones that I just talked about. But Ramelius is great to hold as well.
Okay, so that's Ramelius, and I love it when fundamental and technical analysts argue because, you know, essentially you're looking at the same thing, momentum. One's just looking at price momentum, the other's looking at earnings momentum. But the studies do show if you combine the two, then you get much stronger result than just one or the other. So maybe I'll just be right in the middle there, in between the fundamental and the technical analysis. Let's go to our next call. We've got Andrew on the line from Melbourne. Andrew, welcome to the show. How can we help you out?
Hi, Julia. I've just got a couple of stocks I've been watching and had been hoping for a pullback in. Isentia and APN Outdoor, and they've both been smashed more recently. Sure. So I'm just wondering if now's the time for me to do it, or perhaps Carl can see them dropping further and some more obvious support levels that might be a better spot to get in.
Sure. So we were talking about some of those higher PE ratio stocks seeing a correction, not just in Australia, but really starting to watch the US for signals here because Australia just seems to be following suit. But Isentia, ISD, looking for a potential entry point here, and also I think it was APN Outdoor, APO's the stock code there. So let's go to Carl. What do you think of these two?
Yeah, look, on ISD first, you know, it's a stock that's had a great trend for a significant period of time, hit 5 and started to come off there. And just watch out when they do hit those key round numbers, you know, 5s, 10s, 15s, 20s are notorious, if only to draw out some supply. I mean, if you buy a stock at 2, when you're thinking where you're going to get out, these round numbers start to come into your head. So it just creates a little bit of supply in the market at those levels. Stocks can stagnate, and then if everything goes wrong in the rest of the market, which is what's happened here, then a bit of supply comes out, and then you have to find those lower support levels. And they'll be, again, around those big handles. So $4 is currently where ISD is at. I think it'll probably hold it in the short term. The medium to longer term prognosis for this one is not great given what I'm seeing, however. So I think if you've got the stock, I think the balance of risks now are too high towards stagnation or continued falls. So I'm a bit worried about it from that perspective. If you don't have the stock and you're thinking of buying, I really couldn't do anything with it until it based a little bit around this $4. It put some time here at that level and then started to move back up, and you'd buy it as again the momentum recovered. The other one, APN, APO, sorry, APN Outdoor, good one. Look, it's a very, very similar chart. This one just simply doesn't have enough data. It's just too new for my models to process at this stage, but it looks almost identical to ISD. Only the $5 level is where the support could and should come in. Again, if I had the stock, I think the balance of probability favours exiting here and avoiding a stagnation or a fall. If I didn't have it, again, it'd be hard to make a strong case to buy given the current momentum to the downside.
Okay, I mean, all these stocks, Richard, you know, high growth stocks, which are being revalued by the market at this point. And I guess it's understandable that we kind of see this reversion to the mean because for a long time, small caps were underperforming the market for years and years and years. And if you have a look at the average PE ratio of something like the Small Ordinaries Index, you know, these are the levels that usually we have seen, you know, a reversion back into some of the bigger stocks. Do you think that's happening at the moment, or? Well,
I don't think the index really sort of sums up small caps very well, because it's like a small caps index is basically your ASX 100, I think. Or no, it's in your ASX 300 at the smaller end. So an ASX 100. So I don't think that the indices really cover our universe, which is sub 300 million. So then you have a lot of stocks that aren't covered in any index, which is why we get a lot of the opportunities of getting like single-digit PEs, dividend yields of 5 and 6%.
Okay, and we do need to go to a break, so we'll be back after the break to get your views, Richard, on Isentia as well as APN Outdoor. We are going to take a short break, but we'll be back to answer more of your questions in just a moment. Welcome back to the program. If you have a question about a stock or shares, our phone lines are now closed, but you can email us on yourmoney@skynews.com.au. But we have a call on the line now. We've got Tony on the line from Brisbane. Tony, welcome to the show. How can we help you?
Well, hello, Julia.
Hi.
If I could please have the panel's thoughts, maybe Richard on Capral CAA and Carl's thoughts on Covarta CVT. Thank you.
Sure. So let's go to Richard on Capral. I guess aluminium business has been pretty tough. Do you think it's going to improve anytime soon?
Yeah, I just think this sort of business, like we were a supporter a long time ago and then we bugged out because I think sometimes there's just global forces that a company is just sort of left twisting in the wind, like the amount of dumping from China and the lack of protection from the government, in aluminium. It makes it just an impressive feat that Capral's sort of still alive. I just think, like the whole building revolution, well, a lot of the construction has actually been in, I guess, residential, not commercial, because the I guess they just, they're really struggling to overcome the dumping, and they've sort of tried to get some commissions going, some action. But I guess when a company's doing that and they're not focusing on trying to, well, they are focusing on trying to boost their profits, but that's what they have to do. Then you're in a very hard place. So I guess we've lost a lot of faith in the position that they're in, which no matter how good their management is, they just cannot get the volumes to overcome their fixed costs.
Absolutely. So we've seen, there's dumping of products from China, and that's impacted heavily.
And the tragedy is other countries like the US and Canada have much better taxes that protect their own industries, and that our country hasn't been able to do the same is a very sad thing.
Okay, so
for Capral shareholders.
That was CAA Capral. Now to Covarta, which looks at security. I remember when this one backdoor listed, I think TPG was a key supporter because it also looks at cloud-based services for some of the telcos. Carl, just having a look at this one, I think it was about 20 cents when it first hit the markets just over a year ago.
Yes, that's right. It got as high as 65, pulled back to about 20 again. Quite often you see that IPO listing price tested after a big run-up. That's what's happened. Good base here. Might I say I'm glad, Tony, that you gave me CVT and not CAA. CVT actually looks really good. It came up as a buy on my system just yesterday. Obviously today's price action didn't help it a lot, but when you look at it against the broader market, one shouldn't be surprised that it did pull back. So I'm still very, very positive on it. It's got some great technical characteristics in terms of, yes, it's had a run, yes, it's had a pullback, but it's had that really important basing pattern where it's removed a lot of that dead wood. Your lower peaks, your lower troughs have based out, turned into higher peaks, higher troughs. There's accumulation on the pullbacks. People are chasing it on the upswings. There's a bit more intensity and a bit more excitement about it. Definitely the volume looks good as well. It's come in, it's died off, it's picking up again. So it looks very prospective to me. 65 is going to be an obvious target level, but it's currently in the low 40s, so that's a pretty good swing if you're after a good sort of short, medium-term trade, which I think this will be.
I mean, I find this interesting. I think it's based out of Washington, D.C., Richard, and yet it's listed here in Australia. Fidelity, which is one of the largest money managers in the world, has, I think, around about a 7% stake in this particular business. I guess it makes sense when your biggest clients are things like governments and defence areas. You don't necessarily want to be sort of situated in the US, given all that we've seen in terms of spying and hacking and everything else. So is being an Australian company an advantage in this area? Would you be looking at this type of company?
Well, I think if you are interested in this space, the one that I've heard the company, I met the company, the managing director, Kevin McLean, he's quite a character. He's got some pretty good stories. And its code is PS&C. And you see, the difference is, and I don't know much about either of these companies, outside of knowing that Kevin's a good bloke, and actually this company is based in Australia, is that this company is actually making profits, PS&C, and like trades on a multiple of 8 times. The other one hasn't even got revenues. So to me, I mean, we wouldn't even bother looking at the other one, whereas we would, PS&C is a company that that we could look at, that would be investable for us. So that's a difference.
Okay.
So they do exactly the same thing, but one company is making money and the other company is not even earning revenues.
Okay, so lots of different ideas in this space. Let's now go to an email. We've got an email here from Andrew who asks, what does the panel think of Ardent Leisure Group, Macquarie Group and TFS Corp? I'm currently holding all 3 and I'm interested in how you think they will perform. Obviously all 3 have been coming under pressure, so let's go to Carl first.
Yeah, just catching up. So Ardent was one of my key disappointments from last year. Started to look very, very good. Gave me all the right signals and then turned down, hit a stop loss for us. I haven't really looked at it since, to be honest. That was around that 250 level. It's now at 191, so important to have that stop loss, a good demonstration there of if you get it wrong, you get it wrong. There's nothing wrong with making mistakes. We all make them in the markets. It's how you deal with those mistakes and how you move on from them, which is more important. Looking at the chart now, it looks pretty terrible, actually. It's actually meeting all the criterias now more for a short than anything else. If I had it, therefore, I would have to say I still think you will conserve some capital by getting out around these levels. Maybe there's some saving grace around 180, which was a key low point for it in the past. Not that I'd want to take the gamble that it will hold that. MQG, canary in the mine shaft, perhaps, for another impending GFC. Could probably draw some parallels with 2008. It's not a stock that I would be looking to buy on a bounce around these levels. It could probably get into the mid to low 50s before we see anything positive there. In fact, really everything's still pointing down on Macquarie. And the last one, TFC, which is basically just as bad as the last 2, to be honest. So, yeah, look, it's a shame. Regretfully, I don't take delight in anybody holding stocks like this. So I feel.
Well, they've made quite a bit of money over
I feel for the caller. Well, we don't know. We don't know where they got in, unfortunately. So hopefully they're making money and they can take some profits on these stocks and move on and find some better opportunities elsewhere.
Okay, so let's have a look at these companies. Let's start off with Ardent Leisure. Of course, Main Event is one of the key drivers driving down the share price at the moment. 22 Main Event centres over in the US, and I think 14 of them are in Texas. So impacted, I guess, by oil. If oil prices were to go up, would you be more positive on Ardent? Would you be buying at these levels? Is it deep value? What do you think, Richard?
Deep value, right. I think, I think as far as leisure stocks go, I mean, like I was talking to a friend, Ed Pendergast, who runs the Pengana Emerging Companies Fund. We're going to be featuring him in tomorrow's Under the Radar report, and he's gone pretty hard on leisure stocks. Not Ardent Leisure, but I mean, a lot of these companies really benefit from a weaker Australian dollar, like tourists coming from overseas and tourists not leaving.
So more like Village Roadshow?
Not so much Village Roadshow. You'll have to, read tomorrow's issue. But I think
Aristocrat looks good. ALM, no.
No, that's not really. Well, that's leisure in certainly a very tenuous sort of form of leisure. Right. But I think like Ardent Leisure, we don't we don't really cover it, but to us, it's out of our universe, almost 100 million, almost $1 billion market cap. But certainly, I think some of the leisure stocks that Ed was pretty enthusiastic about should do pretty well this reporting season from a weaker Australian dollar.
Okay, and I guess Macquarie Group,
Well, Macquarie Group's just,
really
like we talk about momentum plays, that is your ultimate sort of, financial markets momentum play. I mean, and like that, as we were saying earlier, these financial stocks have been really hit because they're trading at very highly leveraged beasts compared to, I guess.
Sorry, I was just sighing in anticipation of the last one, which is TFS Corp, which is Sandalwood, which sells for $4,500.
We always miss Sandalwood. I keep hearing about it and I keep missing it.
But it is due up with an update at the end of the month. But PE ratio of about 3, which means, the market's pricing it for bankruptcy, which I can't see happening. It's just come into harvesting, which should be a key inflection point in terms of the shares. So tuning into its update, I think it's due out with its numbers on the 26th of February. And on that note, that's all we have time for today. Thanks so much to our guests tonight, Richard Hemming from Under the Radar and Carl Capolingua from Investor Systems. And to you, our viewers, for all your calls and your emails. Until next week, I'm Julia Lee from Bell Direct. Thanks for your company.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.